put your hand up if you've kissed more than one person. And people would put their hand up and we're like, well, that's diversification. You know, you're spreading the love. You're not putting all your eggs in one basket. You hear so many horror stories about investing in the stock market, which I hate because 9 times out of 10, it's from people that haven't diversified. I'm like, I would rather go to sleep and not have to wake up in the middle of the night to make sure that my portfolio hasn't fallen off a cliff. It's one of the easiest ways, and it's not a lazy way. It's not a cheating way. It's not a, get rich quick way. It's literally a strategy that many, many great investors have used.
Kia ora and welcome to Shared Lunch, brought to you by Sharesies. I'm Sonya Williams, co-CEO and co-founder at Sharesies, and we're on a mission to create financial empowerment for everyone. Today on the podcast, I'm excited to welcome back Victoria Harris, co-founder from financial education and investment platform, The Curve. In this episode, we'll get into the nitty-gritty of diversification, what it means, when to do it, and some potential ways on how to do it. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Victoria, welcome back to the podcast.
Hi, how are you? Thanks for having me.
Really cool to have you here to talk about a very cool investing topic, diversification.
One of my favourite words.
Well, love that. Do you want to tell us a bit about what diversification is?
Yes, so diversification it sounds like a mouthful, but really it's all about spreading your risk. So investing in lots of different things, spreading the love, splitting up your investments so you're not susceptible if you put all your investments into one company and it didn't do well, then you wouldn't be too happy. So it's spreading the love around and spreading your investments around so you're less susceptible to one bad decision.
Yeah, and so let's jump into that a little bit more. So what are the benefits? Like why diversify?
The best thing that we want to do when we invest is we want to get great returns with the lowest amount of risk. And that's what everyone wants to do at the end of the day. And the best way to do that is to spread your investments around multiple things, whether it's investing in lots of different companies, so like investing in the S&P 500, which is the top 500 companies in the US, or spreading your money around different assets, so that could be property and stocks, or investing in different sectors. There's lots of ways that you can diversify, but essentially diversification is so that you are reducing your risk, and it's just a really great investment strategy for building long-term wealth.
You touched on it as well. It's also like looking at your whole wealth picture and how you might split or consider diversifying, your income or things like that.
Yeah, that's a really good point. You can diversify in many ways throughout your life. At the end of the day, it's just all about reducing your risk. If you had diversified income streams and you lost your job and you still had your side hustle, then that's great. You'd have less stress if something happened or if something didn't go right. And so that's the whole point of diversification, is to kind of, reduce the stress when something doesn't go right, protect yourself, while also on the investing side, kind of build your wealth in a really sustainable kind of wealth creation way.
Is it just something you should consider when you're getting started, or is it, something that you need to worry about when you're an experienced investor too?
When we started educating and we were talking about diversification and we were talking to beginner investors, what we noticed was that it was almost stressing them out more, because they were like, well, all I want to focus on is finding the right investment or investing in one thing, let alone something else and something else and something else, and diversifying. And someone said one day to me, they were like, diversify when you can. So if you're investing in the stock market and then you have the financial ability to invest in the property market, then you should. So it's like, but don't stress yourself out being like, oh gosh, I have to invest in property and stocks and diversify within property and diversify within stocks and get stressed out about how much you have to diversify. It's like, start with one thing, and diversify in that if you can, and then diversify beyond that.
Yeah. I just saw that kind of meme pop into my head of the person staring off into middle distance while all the calculations are going on as you're talking about diversifying within diversifying and diversifying.
Even diversifying the word itself, diversification, like people's eyes glaze over, and we'd say, put your hand up if you've kissed more than one person, and people would put their hand up, and we're like, well, that's diversification. You're spreading the love. You're not putting all your eggs in one basket. If you start dating, you don't want to date just one guy in case he might be a plonker, and then you got to start again. It's like just, not date multiple people at once, but, keep your options open. You might have a successful one, you might have a dud. So it's the same with investing. It's like invest in lots of different things. So if one doesn't do as well, it's like, so what? I've got all these other ones that are doing well, and it's not going to be as impactful for me on my stress levels, but also my finances.
Yeah, totally. So now that we've established that, it's really cool. It's really important as part of your investing, and considering wealth as a whole. When should people and how should people consider to start seriously thinking about diversifying or moving different things into different buckets?
Yeah, I think the simplest and easiest way is to start with ETFs. It removes the thought process of like, okay, well, how many stocks do I have to invest in? Is it 4? Is it 10? Is it 20? Do I have to pick all those companies? It removes that decision making element while you still get access to the US stock market. Say if you invested in the S&P 500, and you're just owning one thing in your portfolio, which is a share in an ETF. Yet you're getting access to all these underlying companies that are in it. And I think that is one of the easiest ways. And it's not a lazy way. It's not a cheating way. It's not a, get rich quick way. It's literally a strategy that many, many great investors have used, which is buying ETFs and getting diversification that way. We get a lot of questions of people asking, do I have to directly pick stocks? And if I want to diversify, what is a correct amount? Is it 5? Is it 10? Is it 20? And there's no real answer. It's, you could have 10 companies that you're investing in that are all in the healthcare industry. Yes, you're diversified, but you're not very well diversified because you've still got exposure to one industry. So it's really thinking about, diversification can reach so many different areas. It can be diversification in size of company. It can be diversification in sector. It can be diversification in country. It can be diversification in asset classes, so stocks, bonds, property. It's never ending.
Can you tell us a bit about different asset classes? We've talked about those, but maybe might be helpful to go into those in a bit more detail.
Yeah, so there's typically kind of 4 asset classes. So we've got stocks, bonds, property, and cash. And the reason that assets are lumped into those classes is because they move in different ways. We've got stocks which are high on the kind of risk, but then high on the reward spectrum in general. And then we've got property next, and then we've got bonds, and then we've got cash. So cash is at the bottom. It's low risk, but it's also low return. If you put $1,000 in the bank, you pretty much know, unless you've spent some of it, that in a year's time you're going to wake up and there'll be $1,000 in there. But because of that guarantee or that that security, you're not taking a lot of risk, so therefore you're not compensated for that, so there's not a lot of return. Whereas with stocks at the other end of the spectrum, because you're taking a lot more risk, then you're getting compensated for it by a higher return, on average. Yeah.
Cool. And how about currencies?
With currencies, it is something to consider when investing. A lot of the companies that we invest in, a lot of the household companies that we know, companies in the S&P 500, they're all US dollar companies. And so we do have to transfer our New Zealand dollars into US dollars. So therefore, if the currency moves in the opposite direction, say our stocks go up, but the currency moves in the opposite direction, then that's going to impact our overall return in a negative way. And so we're not going to get as much of a return when we convert our our profits or the money that we've made in those stocks back to New Zealand dollars. And the opposite can happen as well, though. So if you invest in US dollars and then the currency moves in your favor, that can boost your returns. So I try, particularly for beginner investors, to not get too hung up about currency. It's very hard to predict, currency moves. And I think if you just accept that, sometimes it'll benefit you and sometimes it might not, but over the long term, it should be the returns of what you're investing in that's the most important.
Say you've been investing for a while now, as you have, and I have. Are there any blind spots, or what are the blind spots? What catches people out?
You hear so many horror stories about investing in the stock market, which I hate, because 9 times out of 10, it's from people that haven't diversified, and it's from people that have put their entire life savings into Bitcoin, for example, and that hasn't gone to plan. And so and then those stories, flow down to beginner investors, and they get spooked and they get scared, and then they don't diversify from day one, and they have the same experience and they never invest again. And that's the opposite of what we want here. But some other blind spots, I think you might not be as diversified as you thought. Like I was talking about with, investing in maybe a healthcare ETF, for example. Yes, you're diversified, but you're still in the healthcare space. So say we had an election that cut a whole lot of healthcare spending, then that ETF would be impacted. Even though you're still investing in a whole bunch of companies within that ETF, you're still overexposed or investing heavily in one sector. That's why the S&P 500 is so great, because that ETF has over 500 companies across over nearly 12 different sectors, big companies, small companies that get most of their revenue from offshore or outside of the US, companies that get their revenue from inside the US. So there's a lot of, risk mitigation going on within that ETF, for example. It's probably not a blind spot, but it's more of something that people might stress out about is having too much focus on being too diversified. So there's what I'm getting at is there is a middle ground. Don't stress yourself out about being, super, super diversified and owning, 20 different ETFs. That's, if you've got a handful of them, that's fine. Or even just one well-diversified ETF. But don't stress yourself out about being, needing to be so diversified that you're just owning things for owning them's sake. You're not actually owning them. You're not actually making a conscious decision of why you own that ETF or stock.
Yeah, that's such a good point. And we see that play out in the data around how people use Sharesies as well. So we've got over 700,000 people investing, and most have, a few funds and a few companies. It's that level of diversification.
That's what I do. That core satellite approach. I should be direct stock picking all my stocks, but I don't have time. I'm trying to run a business as well, and it's I'm still interested in investing, and of course I want to grow my money and grow my wealth. So I'm going to put 80% in ETFs and funds. But then I might read about a company that I'm oh, that's interesting, or buy companies that I want to almost double down and support because I think they're going to do really well. So I'll do that as well. So there's no right or wrong. It's kind of what works for you as well.
Yeah, that's so great to hear, because that's exactly how I invest as well. And it's one of those almost myths that we're trying to bust, which is when people say, oh, I'm just a beginner, so I invest like this. And it's well, I've actually been investing for a while now, and I invest like that too.
I know, yeah.
So it's kind of almost trying to, that is where, it's the great principles to start with, great principles to continue doing. And it's cool to hear that, and it's well known, that really sophisticated investors can continue to invest in that way.
Yeah.
coming back to your comment about like when you come across like a few companies you're keen to invest in as part of that core satellite approach, there's another phrase that you hear a lot in investing, which is like invest in what you know. How do you think about that, and what are your reckons?
Yeah, I love that. I love that phrase. And it was I remember my first day as an analyst, and my boss threw a book down on my desk, and he said, "I don't want you to do anything today. I just want you to read this book." And it was Peter Lynch, One Up on Wall Street. And the key takeaway from that book is invest in what you know. And that has just stood by me, my entire investing career. And it's so true. And I think investing has got, so complicated and can be so overwhelming and confusing for so many people. But if you strip it back, it's like, what do you enjoy? What are you passionate about? What are you interested in? What products do you use? And it's like, what are your values? Like all of that just comes down to investing in what you know. And for me, it's like, I don't know biotech. I'm not going to know if some clinical trial is going to be a success. I'm not going to invest in those companies. Like, I'll leave them for someone else to invest in. I'm going to stick to companies that I'm interested in, like technology companies, media companies, retailers. All of that really interests me, and it doesn't seem like it's tiresome or it's just something I have to do. It's because I'm interested in it. I'm following those companies. I'm reading articles on them. I'm using their products. I'm using their new features. So I know, because I'm a user and it's a company I know. If for whatever reason I don't use it anymore, or I see all my friends not using it, or they're using some other platform, or they're buying a different product, then that's research, and that's investment research. And so I'll be like, oh, hang on, if all these people and myself are now no longer using this product or no longer interested in this company, surely there must be other people. And so you start to be in this investing world without realizing it. And at the end of the day, if you're a consumer and you're voting with your wallet for that company, you may as well benefit as an investor as well, and benefit from that company's growth. If you're kind of giving it the tick of approval as a customer, it kind of makes sense to double down and benefit from it as an investor as well.
Yeah, I love that. And I think the way I think about it too is, it really, you can turn observation into your superpower, because when you invest in the things that you're just around and you're amongst and you're observing, you can really say, as you say, like the taste of this thing has changed, or they've changed the recipe. I'm not that into it.
And something like for women, it's like we're like make up 80% of global spending. And so it's like, yes, you're a consumer. So it's like you are dictating where that money is spent, as a gender, or, your majority of spending. It's like you can see these trends and you are almost part of the trend. So you've got that foresight before a lot of other people, particularly men, might have. It's like using these things to your advantage, rather than kind of being like, oh, it's not a world for me, or it's I'm not part of it. It's like we're all part of it, whether we like it or not. It's like,
yeah, that's such a good point. Let's deep dive into risk. Like how does risk play into diversification, and how should people think about that?
Yeah, so risk is effectively the movement up and down of prices. So if something is got big movements in its price, then it's got a lot of risk. So things like cryptocurrency, there's big moves in cryptocurrency. Bitcoin, for example, has moved around a lot over the last couple of years. Therefore, it's quite risky. So when it comes to risk and diversification, the two are intertwined in the fact that, yes, if you spread your risk, so you invest in lots of different companies, let's say for argument's sake, you invest in lots of different companies, some of them might have big moves, some of them might not move at all, but the average of those is not a lot of movement. I think it comes back to, you never know what's around the corner. And yes, you might invest in something that has done very well over the last few years, and you know the ins and outs of that investment or that company or whatever it is, and you are so positive that it's going to do well, but the world is so unknown, and you never know also how other investors are going to react, because when you're buying and selling a share, that's off other investors. So how they react is you also have to take into consideration. If they don't want to own this stock anymore or this company, but you do, and there's a whole lot more of them than there are of you, then the share price is going to go down. So you've got to take all that into consideration, as well as kind of what's going on with the company, the world. There's a lot going on that you need to consider if you are just going to invest in one thing. We didn't foresee COVID, for example, and that led to a lot of share price falls. But again, that's probably a really good example of diversification. If you'd owned, heading into COVID, if you'd owned just travel companies, then your portfolio would have looked pretty dire. Whereas if you'd owned some travel companies and some tech companies, you would have, fared a lot better. Yes, the travel companies would have gone down and the tech companies would have gone up.
It can be an event like that, but it can also just be the subtle changes of trends or how people, I think even at the moment when you consider like run club culture, like that feels like something that's like really a fundamental shift. That it's like almost going back to, like aerobics in the 90s being this really big, the whole like social and exercise coming together. You're like, I see where this is going. But like when you come back to the COVID thing, like who would have thought that it would be totally fine in a lot of businesses to work remotely, to, like there's just so much that has reset in motion that, new like emerging technologies or emerging ways of doing things, emerging businesses, like new stuff pops up too.
And in those times, when there is uncertainty, you want to worry about yourself. You don't want to sit there worrying about your investments. And so if you diversify, there's kind of less uncertainty you have to worry about. You can be selfish. You can just worry about yourself because you've got your investments sorted. And so you can just focus on the things that are important rather than stressing about your investments, because that's not a great use of anyone's time.
I do the sleep at night test, which is just like, that to me is priceless.
Yeah.
So it's like, winning is awesome, but like I would rather have a portfolio that meant that I could sleep at night and sleep comfortably.
Yes. Yeah. And some people love having the spicy stocks or assets in their portfolio, and that's fine. That is not for me. I'm sorry. I would rather go to sleep and not have to wake up in the middle of the night to make sure that my portfolio hasn't fallen off a cliff. I would rather do a more pragmatic, considered, tried and true way of investing through diversification. Yeah.
Yeah. Bit of garnish here and there.
Yeah. A little spice, bit of chili flakes would be good. Yeah.
But so how does it differ between, how an individual might think about it or manage diversification versus like a professional, like a fund manager, or different money managers?
Yeah. So when I was a fund manager, we were active fund managers. So we were out there picking stocks, picking companies on behalf of clients. And so we had a duty to make sure that the portfolio was well diversified all the time. And that was the reason that our clients had given us money, was to make it grow. And so we had to make sure it was diversified. So we would have about, depending on the fund, but an average of maybe like 30 different companies to invest in, to make sure that we were properly diversified, as well as generating good returns. And so that's kind of when you give your money to a fund manager, or an active fund manager, that's what they'll do for you, and that's what you pay them a fee for. The thing with the professionals is they've got usually teams around them, so it's not just. And when you're doing it individually, you usually only got yourself. So it's they've got a lot of other people and systems and research feeding into those decisions. So when I say they're picking kind of 20 to 30 stocks to be diversified, you doing that yourself is going to be a lot more time consuming and a lot more take a lot more research and effort. If you're doing it yourself, then the best way is to do it through an ETF where you're getting that diversification. You're not getting that kind of personal element because it's ETFs are essentially run by computers. They don't really change that much. They're pretty stock standard. But as an individual, you can pick that yourself, and the fees are a lot lower. So an ETF is usually the easier, but also, in most cases, just as high returning strategy to invest in. Yeah.
You mentioned like diversifying within diversifying within diversifying.
Yeah.
Can you be too diversified? And what do you do about it once you realize?
If you're investing in things that you either don't understand, you don't know, you don't want to own, but you just have to own because you want to be diversified, that's not a good sign. Because then if it doesn't do well, you won't know why you owned it. You won't know what it does. And it's just, I think you can definitely have too many things in your portfolio. It can become very stressful, being across, all those companies, what's going on, their financial results. What if the CEO leaves? What if there was a product failure? What if there's some technological innovation at a competitor? Or what if, there's a lot of things to be going on. There's a lot of things to be across when you own a lot of companies in your portfolio. Some people love that, and that's great. But I think for a lot of investors, that can be very overwhelming and almost take the shine off investing and the fun off investing. And I think that's a place we don't want to get to. I think you can achieve the same or a similar outcome by a much more simplified strategy, and that is through ETFs. And I'm not endorsed by any ETF anyway. Keep holding up the flag for ETFs, but I'm definitely not being endorsed by them. But I just think it's for a beginner to intermediate, even advanced investors. I just feel like it's such a good strategy, and it makes for a very clean looking portfolio as well.
If our listeners were to take 3 actions from this episode, what do you recommend?
If you're beginning your investing journey, always start with diversification. Also invest in what you know, and go to a farmer's market and buy some oranges and apples.
Love that. Get your 5+.
I couldn't think of a third one.
Oh, and hey, what was the book that you got handed when you were at work that day?
Yes. Peter Lynch, One Up on Wall Street. It's very old. It's probably like 40 years old now. But like that, even in itself, there's people that have made fortunes that have been investing this way for such a long time, and it's stood the test of time, and it's still a way that I invest today. And it's Peter Lynch, One Up on Wall Street. Great book.
Awesome. Love a good book recommend. I'll add that to my Goodreads. Hey, thanks heaps for joining us, Victoria. It's been an awesome conversation.
Thanks, Sonya.
Thanks everyone as well for tuning in. You can watch it Shared Lunch on YouTube, or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a rating and comment what you'd like to hear about next, and enjoy the rest of your week.